There is a brand new $6,000 tax deduction designed specifically for Americans age 65 and older. Congress approved it in 2025. It applies to the taxes you are filing now for 2025, and it continues through 2026, 2027, and 2028. But here is the issue. The IRS is already rejecting some claims. Thousands of seniors are missing this deduction, not because they are ineligible, but because they are making 4 very specific mistakes that shut them out completely. In this video, I am going to walk you through all 4 of those traps. I will show you the exact dollar math at 3 different income levels, and I will tell you how to make sure you receive every single dollar you are legally allowed to claim. Plus, stay with me through the end because there is a 4-year window here that smart retirees are going to use to save tens of thousands of dollars. If you miss this window, it is gone forever. Let me begin by explaining exactly what this deduction is, because there is a lot of confusion floating around online, and some of that confusion could cost you money. Congress approved a sweeping piece of legislation in mid-2025 called the One Big Beautiful Bill Act. You may have seen it referred to by its initials, OBBBA. Inside that bill was a new provision created specifically for seniors. They called it the Senior Bonus Deduction, and the amount attached to it is $6,000 per qualifying person. If you are 65 or older, this is one of the most important new tax benefits created for retirees in years, and most people have no idea it exists. If this is already helpful to you, hit that like button right now. It tells YouTube to show this video to other retirees who need this information. Here is something I need you to hear clearly. This deduction is not permanent. It is not part of the regular tax code that will be there year after year. This deduction applies only to tax years 2025, 2026, 2027, and 2028. After December 31st of 2028, it is gone. It expires. You get 4 years to use it, and not a day longer. That is why smart planning right now matters so much. Before we move on, I want to clear up something I keep seeing in the comments on other videos. A lot of people are mixing up this deduction with the idea of no tax on Social Security. Those are 2 completely separate things. The no tax on Social Security proposal is a different policy discussion. It is not the same as this $6,000 senior bonus deduction. The senior bonus deduction lowers your overall taxable income by $6,000. It does not automatically erase taxes on your Social Security income specifically. Those are separate calculations. Now that we have that straight, let me explain exactly how it works. Every year you file your taxes, the government lets you lower your taxable income by either the standard deduction or the total of your itemized deductions. Things like mortgage interest and charitable gifts. You choose whichever is larger. The senior bonus deduction sits on top of that. It is an additional $6,000 subtraction from your income claimed directly on Form 1040 in the deduction section. And here is something important. This deduction works whether you use the standard deduction or whether you itemize. It does not matter which route you take. Either way, the $6,000 goes on top. There is already an extra standard deduction that applies when you turn 65. For 2026, that added amount is roughly $1,600 for a single filer and $1,300 per qualifying spouse. The new $6,000 senior bonus deduction stacks on top of that existing age 65 benefit. You do not lose the old one to get the new one. This is explained in IRS Publication 554. Which is the official publication for older Americans and their tax returns. I strongly suggest you look it up or have your tax professional reference it. Now, let's talk about who actually qualifies. This is where I need you to pay close attention because the rules have some very specific edges that can trip you up. You must be 65 years old by December 31st of the tax year you are claiming the deduction for. If we are talking about your 2026 tax return, the one you file in early 2027, you need to have been born on or before December 31st, 1961. If you turn 65 on January 1st, 1962, you are 1 day too late for 2025 and 2026. You will qualify starting with the 2027 tax year. That may feel unfair, but that is the rule, and the IRS will enforce it. You must have a valid Social Security number to claim this deduction, not an individual taxpayer identification number, also called an ITIN, a Social Security number specifically. We will cover this in more detail in denial reason number 4, but I want you to know now that this is a hard requirement. No SSN, no deduction, period. The deduction starts to shrink and eventually disappear when your income rises above certain levels. The technical term for the income they measure is MAGI, which stands for Modified Adjusted Gross Income. For single filers, the phase-out begins at $75,000 of MAGI, and the deduction disappears completely at $175,000. For married couples filing jointly, the phase-out begins at $150,000 of MAGI and disappears completely at $250,000. If your income is below those starting points, you get the full deduction. We will show you the exact math in a few minutes. For married couples filing jointly, each spouse qualifies independently. If both of you are 65 or older, you each get $6,000 for a combined total of $12,000 taken right off your taxable income. If only one spouse is 65 or older, you get $6,000, just the one qualifying spouse's amount. The other spouse does not automatically get a deduction. Here is something that catches a lot of couples completely off guard. If you are married and you file your taxes as married filing separately, not jointly, but separately, you are completely disqualified. Not partially reduced, not slightly limited, completely disqualified. Zero deduction. We are going to break down exactly why some couples choose that filing status, and why, in the context of this new deduction, it can be a very costly mistake. Now, this next section is where most retirees get hit hardest. The first denial reason disqualified an entire married couple from a $12,000 deduction. Let me show you the math. Let's talk about why some married couples choose to file separately in the first place. Because there are legitimate reasons. I want to be fair here. Reason 1. Medical bills. If one spouse has very high medical expenses, there is a tax rule that says you can only deduct the portion of medical costs that exceeds 7.5% of your adjusted gross income. If that spouse files separately with a lower individual income, that 7.5% threshold is lower, and more of the medical bills become deductible. Reason 2. Federal student loans. Some retired parents or spouses are still paying student loans on income-based repayment plans. If they file jointly, both incomes count toward their loan payment calculation. Filing separately can reduce those loan payments significantly. Reason 3. Separation or financial disagreement. Sometimes, spouses simply do not want to be legally responsible for each other's tax liability. Filing separately keeps those tax obligations separate. These are real situations, and I am not here to tell you those reasons are wrong. But here is the catch, and it is a big one. The One Big Beautiful Bill Act language is crystal clear. If your filing status is married filing separately, you are completely disqualified from the Senior Bonus Deduction. Not reduced, not partially available, fully disqualified. You get $0 of this deduction, both of you. The IRS is not going to give you a break on this one. The statute is explicit. Filing separately costs you the entire benefit. Let me show you the actual math so you can see what this mistake costs in real money. Let's say you and your spouse are both 65 or older. You are considering filing separately because of medical bills that could save you about $400 on your spouse's separate return. If you file separately, you save $400 on medical deductions, but you both lose the $12,000 senior bonus deduction. Assuming you are in the 12% federal tax bracket, which covers married couples with taxable income up to around $94,000, that $12,000 deduction would have saved you $1,440 in actual taxes. You saved $400. You lost $1,440. That is a net loss of $1,040. And that is the trap. Most tax software will let you file whatever way you choose, It will not automatically warn you that you just gave up a $12,000 deduction. That warning has to come from you or from a tax professional who knows this rule. Here is what every married couple needs to do before they file this year. Run both scenarios. Have your tax preparer or your software calculate the return both ways, jointly and separately. Look at the total tax due in both situations, not just the deduction you are chasing. In almost every case, the overwhelming majority, filing jointly will come out ahead when the $12,000 senior bonus deduction is on the table. If you are learning something new here, do yourself a favor and subscribe. Hit the notification bell so you get the next video the moment it comes out. We cover this stuff every week. No fluff, just facts. But wait, the next trap is even sneakier because it does not disqualify you all at once. It quietly takes your money in pieces. Let me show you exactly how the phase-out math works. This one is more complicated, and it is where a lot of people with moderate to higher retirement incomes get a rude surprise. The deduction does not just cut off abruptly if you make too much money. Instead, it phases out gradually, meaning it shrinks dollar by dollar until it is gone. But before I can explain the phase-out, I need to make sure we are talking about the same number because there is a lot of confusion between different income figures. Let's keep this simple. You have 3 different income numbers on your tax return. Number 1, your gross income. That is everything that comes in: your Social Security, your IRA withdrawals, your pension, your part-time work, your investment income, everything. Number 2, your adjusted gross income, or AGI. That is gross income minus certain deductions like IRA contributions, student loan interest, and a few others. Your AGI is the number at the bottom of page 1 of Form 1040. Number 3, your modified adjusted gross income, or MAGI. This is usually very close to your AGI, but with a few things added back in that you may have deducted. For most retirees, your MAGI and your AGI are the same number or very close to it. For this senior bonus deduction, the IRS uses MAGI to determine how much deduction you can take. And here is the specific breakdown. If you're filing as a single person, your phase-out range runs from $75,000 to $175,000. Below $75,000 in MAGI, you get the full $6,000. Between $75,000 and $175,000, the deduction shrinks proportionally. Above $175,000, it is gone. If you are married filing jointly, the phase-out range runs from $150,000 to $250,000. Below $150,000, you get the full $12,000. Between $150,000 and $250,000, it shrinks. Above $250,000, it disappears completely. Now, let me show you the real math with 3 example couples. They are both 68 years old. They have Social Security income of $36,000 combined, a pension of $24,000, and they took a $40,000 distribution from Bob's IRA this year. That puts their total MAGI at roughly $100,000. $100,000 is well below the $150,000 phase-out starting point for married couples. So, Bob and Linda get the full $12,000 deduction. If they are in the 12% federal tax bracket, that $12,000 deduction cuts their taxes by $1,440 in actual dollars. That is real money. That is a utility bill. That is a prescription budget for months. That is a flight to see the grandkids. Now meet Frank and Carol. They are both 71. They have Social Security of $48,000, pension income of $60,000, and investment income of $72,000. Their MAGI comes to roughly $180,000. That puts them inside the phase-out range. They are $30,000 above the $150,000 floor, and the phase-out range is $100,000 wide. So they lose 30% of their deduction. That is $3,600 gone. Instead of $12,000, they get $8,400. At the 22% tax bracket, That is about $1,848 in actual tax savings. Not the full benefit, but still meaningful, still worth understanding, and still worth claiming correctly. Now meet Richard and Susan. They are both 74. They have a larger pension, rental property income, and significant IRA distributions. Their MAGI comes to $260,000. That is $10,000 above the $250,000 complete phase-out point for married couples. They get nothing. Zero. The deduction is fully eliminated at their income level. Now, Richard and Susan are doing fine financially, but they might be asking, is there anything we can do? And the answer is, maybe. But it requires planning that should have started a year or two ago. Let me give you a few strategies that savvy seniors use to manage their MAGI and stay in the deduction zone. These are not guaranteed fixes, and every situation is different, but these are legitimate tools worth discussing with your CPA. Strategy 1. Roth conversions in prior years. If you converted money from a traditional IRA to a Roth IRA in earlier tax years, those Roth withdrawals in retirement do not count toward your MAGI. Smart retirees who did Roth conversions before they needed the money are seeing the benefit now. Strategy 2. Qualified charitable distributions. If you are 70 and a half or older and you are required to take money out of your IRA, you can make a qualified charitable distribution, also called a QCD, directly from your IRA to a qualified charity. That money never shows up in your MAGI. For 2026, you can do up to $18,000 this way. Strategy 3. HSA contributions. If you are still working and have a high-deductible health plan, health savings account contributions reduce your MAGI. This is less relevant for full retirees, but useful for those who are still employed. Strategy 4. Capital loss harvesting. If you have investments with losses in your taxable accounts, selling them to offset gains can reduce your investment income and therefore your MAGI. A financial advisor can help you with this one. If you're still with me, you're doing better than 90% of retirees who never learn this stuff. But stay around. The next 2 denial reasons may be the most surprising of all. This one feels unfair, and honestly, it is a little harsh, but the rule is clear. So let me walk you through it. To qualify for the Senior Bonus Deduction in any given tax year, you must be 65 years old by December 31st of that same year. Not January 1st of the following year, not within 30 days, December 31st. That is the hard line in the tax code. So, if you were born on January 1st, 1962, you will turn 65 in 2027, but you do not qualify for the 2026 tax return because you were not 65 during 2026. You will first qualify for the 2027 return, and you will have 2027 and 2028 to claim the deduction before it expires. If you were born on December 31st, 1961, you are fine. You turn 65 on the very last day of 2026, and you qualify for the full deduction. 1 day difference, same deduction amount. That is how strict this is. Now, here is something a lot of married couples run into. What happens when one spouse is 65 and the other is not? Let me give you a real example. Meet George and Patricia. George is 67 years old. Patricia just turned 63. They file jointly. George qualifies for the $6,000 senior bonus deduction. Patricia does not. She is not 65 yet. So this couple gets $6,000 total, not $12,000. Patricia will likely qualify in a future year, assuming she turns 65 before December 31st, 2028, which is the last year the deduction exists. If she turns 65 in 2027, they will be able to claim $12,000 in 2027 and 2028. This makes planning ahead critical. You need to know when each spouse qualifies and then decide how to maximize the deduction in the years you have available. There is actually a long-standing IRS rule, and this goes back to publication 554. that says for certain age-related tax provisions, someone born on January 1st of a year is considered to have turned that age on December 31st of the prior year. However, the specific language in the OBBBA legislation establishes its own bright line. Check with your tax professional about your specific birth date situation, because interpretations may vary, and this is worth confirming in writing. This denial reason is the most straightforward, but it affects a specific group of retirees in a way that can feel very unfair. To claim the Senior Bonus Deduction, you must have a valid Social Security number, a 9-digit number issued by the Social Security Administration, that is, the SSN. Most Americans have used their entire working lives. What does not qualify? An individual taxpayer identification number, also known as an ITIN. The IRS issues ITINs to people who need to file taxes but do not have and are not eligible for a Social Security number. ITINs are most commonly used by certain immigrants, including those on specific visa types, and by some foreign nationals who earn income in the United States. Some of these individuals have lived in the United States for decades, pay their taxes faithfully every year, and are over 65 years old. If you are in that situation, and you file with an ITIN, even if everything else about your return qualifies, you are disqualified from this deduction. That is the rule as written in the OBBBA legislation. If you or someone in your family is filing with an ITIN, the first thing to do is figure out whether you are actually eligible for a Social Security number. Some individuals become eligible for SSNs through changes in their immigration status or citizenship. If you have become a U.S. citizen or a lawful permanent resident, you may be able to apply for a Social Security number through the Social Security Administration. If you obtain a valid SSN before the tax filing deadline, you may be able to amend a prior year return, but this is highly situation-specific. Talk to an enrolled agent or an immigration attorney about your individual circumstances. Before we continue, the next section is critical. If you live in a certain state, Virginia residents who thought they were finished could be in for a nasty state-level surprise. Let me tell you exactly what happened. You have cleared all 4 federal denial reasons. You know your filing status. You know your MAGI. You checked your birthday. You have your Social Security number ready. You are set to claim your $6,000 or $12,000. And on your federal return, you are absolutely correct to do so. But if you live in Virginia, there is one more trap waiting for you. When Congress passed the One Big Beautiful Bill Act in 2025, Virginia's state lawmakers looked at it and said, "We do not want our state tax code to automatically track this new federal deduction." In tax language, they decoupled from federal law for this provision. What this means in practical terms is that you can claim the $6,000 senior bonus deduction on your federal Form 1040. The IRS honors it. Your federal taxes go down, but when you file your Virginia state return, you have to add that $6,000 back into your income. Virginia does not recognize the deduction for state tax purposes, so Virginia residents get a smaller total benefit than residents of most other states. You still get the federal savings. That is real money, but you do not get the matching state tax savings. Virginia was not the only state to look at this. Other states have been considering whether to adopt or reject the federal provision. I cannot name specific states and guarantee their current status without checking the latest legislation. Tax law changes quickly, and this is an area where what was true 6 months ago may have changed. The action step here is simple. If you live in any state, ask your tax preparer specifically whether your state has decoupled from the senior bonus deduction. Do not assume your state follows the federal rule. If you are a Virginia resident and you have been expecting to lower your state tax bill through this deduction, you need to reset your expectations, and you may want to raise your state withholding or estimated payments accordingly so you do not wind up with an unexpected state tax bill in April. We have spent most of this video talking about what can go wrong. Now, I want to switch gears and talk about what can go very right. If you plan wisely during this 4-year window, say it with me, December 31st, 2028, that is when this deduction ends. Congress did not make it permanent. They gave it a 4-year sunset. Use it or lose it. That is the reality. And the smartest retirees I know are not just taking the deduction. They are using this window to completely reshape how their retirement income is taxed. Here is the strategy that could be worth tens of thousands of dollars to the right retiree. Many of you have money sitting in traditional IRAs and 401ks. Every dollar you pull out of those accounts is taxed as ordinary income. That tax burden does not disappear. It just gets delayed until you take the money out or until the IRS forces you to at age 73 with required minimum distributions. During these 4 years, 2025 through 2028, the Senior Bonus Deduction gives you extra room to do Roth conversions at a lower effective tax rate. Here is a simplified example. Say you are in the 22% federal tax bracket and you convert $50,000 from a traditional IRA to a Roth IRA this year. That $50,000 would normally add $11,000 to your tax bill. But with the $12,000 Senior Bonus Deduction, assuming you and your spouse both qualify, that $12,000 offsets a big chunk of that conversion. The net tax impact on the conversion is much smaller. Roth accounts grow tax-free. Withdrawals in retirement are tax-free. Your heirs inherit them tax-free. And by converting now, while you have this deduction available, you are moving money out of a tax-heavy account and into a tax-free one at a discount. I want to be direct with you. This window is not waiting on you. 2025 is already underway. 2026 will be here before you know it. By the time most people work out a strategy like this, 1 or 2 years of the window will already be gone. The time to talk to your CPA or enrolled agent about this is now, not next March when you are scrambling to file. In our next video, I am going to go much deeper on the Roth conversion strategy during this 4-year window, including specific tax bracket math, the sequences that work best, and the mistakes that could actually make your tax situation worse. Make sure you are subscribed so you do not miss it. Stay right here because the recap coming up is going to lock all 4 of these denial reasons in your memory. And I have a specific request for you before you leave. Let's do a quick recap of everything we covered today. There are 4 denial reasons that can cost you this deduction entirely. Denial reason number 1. You are married and you filed separately. The OBBBA completely disqualifies married filing separately filers. Run both scenarios before you file. Denial reason number 2. Your MAGI is too high. Single filers phase out between $75,000 and $175,000. Married joint filers phase out between $150,000 and $250,000. Denial reason number 3. You are not 65 by December 31st. That birthday cutoff is absolute. If your spouse is younger, you each qualify independently. No cross-spouse credit. Denial reason number 4. You filed with an ITIN instead of a Social Security number. The SSN requirement is non-negotiable. Check your eligibility for an SSN if you currently file with an ITIN. And if you are in Virginia or want to confirm your state, ask your tax preparer whether your state decoupled from this deduction. Do not assume. If this video helped you, please share it with a friend or family member who is 65 or approaching 65. They may not know this deduction exists, and you could save them real money. Hit the like button, subscribe if you have not already, and turn on that notification bell so you catch the next video where I go deep on the Roth conversion strategy during this 4-year window. That one is going to be even more valuable than this one. I will see you in the next video.